Hello and welcome to CMC Markets Weekly Trading Outlook for the week of October the 27th, 2014. My name is Colin Szynski, Chief Market Strategist. Our topic this week is End of QE is just the beginning. The main highlight in terms of news this week by far is the U.S. Fed meeting where they're expected to do the last of their tapering and bring to an end the QE3 program that's been going on and supporting the markets and the U.S. economy for the last 2 years. The reason they're doing this is because the U.S. economy is improving. So in a way, people are now looking past this meeting and into what's going to be next for the Fed. Will they start to raise interest rates sometime in 2015, middle of the year, earlier, or a bit later? And what does this mean for the U.S. economy? Well, we also get a lot of news out of the United States that will give us an idea of where the U.S. economy is actually heading. Not only do we get another series of earnings reports from major companies, but also we get the first attempt at estimate of U.S. GDP for the third quarter. The second quarter was very strong as the U.S. rebounded from a difficult winter. People will be looking now to see what happens now. Did this momentum really continue into Q3 and beyond? How strong is the U.S. economy? Is it continuing to accelerate? This week in the markets, we had a very strong rebound. It's been an up and down October for markets on a day-to-day, week-to-week basis, and sometimes even an hour-to-hour basis. But heading into the new week, the U.S. markets have actually been picking up quite well. And we'll start with a analysis on the chart of the Nasdaq because that's one of the more active indices. I look at the Nasdaq quite a bit because it shows me what's going on with the growth companies and companies that oftentimes are momentum plays and can carry higher valuations. So it tells you at the margin where is the money moving? Are people aggressive? Are people going defensive? So looking here at the markets, we can see that October started out. We started out with a bit of a correction late September, early October. We had a plunge in the just before the 15th of October. Around the 15th and 16th, we had this doji candle here showed that the sellers were running out of gas. A bounce here off of a 61% retracement level, and then back above the 200-day moving average. For the last week, the Nasdaq has been steadily climbing. It now finds itself back up around the 4,000 level, and at a fairly key turning point. Does it have enough momentum to keep on going and challenge this the 4,100 high once again, or could we see it roll over and start to go sideways over the next several weeks? The RSI shows us that upward momentum has picked up. It's broken out of a downtrend. It's back above 50. It's retested 50 as new support, all of which are excellent technical indicators, and it's starting to move up. So momentum is generally turning a little bit more positive for U.S. indices, but there's a ton of news coming out over the next 2-3 weeks that could still keep markets choppy. In addition to the Fed meeting and the GDP report this week, then the next week on top of that, we then have purchasing managers and employment, and also in early November we get the U.S. midterm elections. Plus we have earnings season continuing to unfold all through this period, so there's lots of room for potential volatility and choppiness in U.S. markets as we continue to move through this period. Something else we'll watch with the U.S. this week is what happens with the U.S. dollar. I'm going to bring up here a chart with the U.S. dollar index, which shows that it had advanced very strongly through August and September. We'd seen it a bit of a correction in the early part of October because it had become extremely overbought on the RSI. Over the last week or so, it's been consolidating. The overbought conditions have eased. The long-term positive momentum has remained positive, but generally it looks as though the U.S. dollar is starting to go sideways. And this is between about 84.70 and 86 for the U.S. dollar index. If we see the U.S. dollar index continue to go sideways, it does seem to be taking pressure off of some other markets. And we'll note in particular gold and crude oil trading. So starting with crude oil, we have another big test for support going on with crude oil here at the $80 level. This is for WTI. It's been oversold on the RSI, and we are starting to see it come up as though some of the downward pressure is easing. So we're seeing it start to stabilize here in this 80 to about 84 range. And what we did start to see last week, and people will be continuing to look for, is signs of, has there been a supply response to this big sell-off here from $107, $108 here down to 80. That's a pretty big hit, almost 25% in the matter of about 4 months. So has there been a supply response? Have people started to cut back? One of the reasons we saw the oil market start to stabilize last week was that there were signs that Saudi Arabia might be easing back a little bit on its production. If we start to see more calls or more people talking that way, that we could see shut-ins in production to bring supply down in line with the reduced demand, then that could help to stabilize the price. Or we also saw from the flash PMI numbers for Germany and China that were a little better than expected. If we see that the slowdown that we're in some economies is not happening as quickly as people had thought, that the demand may be holding up a little bit, that can also help to bring that supply-demand balance back in line and help to stabilize the price. Take a quick peek at gold here, which also is responding quite dramatically to the U.S. dollar, of course, and is quite sensitive to it. Gold had a big sell-off from July through the beginning of October, pretty much in line with what was going on with the big rally in the U.S. dollar. Of late, we've seen gold start to consolidate between about 1230 and about 1250. It may continue to level off. We could see a bit more of a pullback. The next Fibonacci supports are in around 1220, then around 1210. RSI did slip down under 50. The question now is, does it just kind of go sideways from here, or do we see it retreat a little bit farther? But overall, gold looks like it's going into a consolidation. Crude oil looks like it's base building, and the U.S. dollar also looks like it's consolidating here after a big run up. It appears as though the decision to end QE3 is pretty much baked into all of these markets. If there was any kind of a surprise, whether comments related to the timing of interest rate increases, or if somehow they actually did decide not to end QE3 here, although it sure is looking like it will, you could see quite a bit of action in the marketplace on that, but really only on any kind of a surprise. If it ends as planned, it looks as though the markets have pretty much priced that in already. We're also looking for a pretty active week in Europe this week, and basically what's going on here is the big news is on Sunday the Europeans are releasing the latest round of stress test results on their banks. A draft report that came out on Friday suggested that 25 banks could fail the stress test and that 10 of them may need more capital. So that's pretty substantial, and that could drive a lot of trading in Europe during the week. Also during the week we do have some news coming out on the economic side, particularly from Germany, where we get consumer prices as well as unemployment. A lot of what's been driving European action lately has been concerns that all the weakness we've seen in the peripheral countries has found its way into the core, is starting to really impact the German economy. Any news we get from Germany could have a big impact on trading across Europe. So we'll look here at client sentiment, which is quite interesting on this. We're seeing, first of all, some extreme bearishness towards the euro at this point in time. We have a substantial short position among clients on the euro US dollar right now. We're looking at about 97% short by position value of top clients and about 88% by all clients. So certainly people are still been looking pretty bearish here on the euro US dollar. Concerns obviously about the banks, about the level of stimulus that's coming in, or the stimulus that might be needed to get the European economy going. On the other hand, looking at the Germany 30 here, clients are a little bit more split. There's about 50-50, so it does reflect that there's still a lot of uncertainty about which way Europe could go. People are mixed. A lot of people think that maybe things are oversold and could get better from here, or that maybe people aren't pessimistic enough and things could go down from here. So based on that, we're looking at 50-50 on the Germany 30, and just highlight that technically. We'll see that as we bring it up here, that it's interesting because we had the Germany 30 in a pretty substantial sell-off late September, early October, and it has had a pretty good rebound here up out of this hammer candle. This was a bear trap where it dropped below 8,500 down to about 8,360, and then had a big rebound. So it looks as though that was quite a washout of selling pressure there. Since then, it's been on the rebound, but now we're starting to see it smack into resistance at some of these previous Fibonacci levels here. This is about 88.30, and it's emerged as new support. We also have here the 9,000 is the big round number, and 90.60, 90.70 here. If you did break that, the next resistance level is up around 91.60, then about 9300. This is the 50-day moving average here, just below 93.50. So far it's mixed. It looks like it could potentially it could continue higher, or it could turn around and go right back down. And there's certainly mixed sentiment on both. But some of the big developments we do see over the next week in Europe could have a fairly significant impact on trading in the DAX. And also even here we've had extreme oversold conditions. We've had a trading bounce, but it has not been able to get back above 50. So momentum has not turned positive, but we had an easing in some of the oversold conditions. It looks like we're heading towards being neutral, but at this point things could go either way. The one thing it does look though is that we could have more volatility and more significant moves, so it's still an environment that favors shorter term trading. Moving on now to it's also a busy week in Asia Pacific markets, and there's a number of things going on, particularly for Japan and New Zealand. I'm actually going to start with New Zealand. They have an interest rate decision this week, and what's significant about this one and why it's important for trading is that the Kiwi dollar has been very active lately. We had it's been hit really hard starting in July. It's been pounded down on multiple occasions here, and not only was this a function of the rebound in the US dollar, but also it was a heavy intervention and selling from the Reserve Bank of New Zealand has been driving this down. And what's interesting here, so we saw it stabilize above with a little double bottom here above 77 cents, and it started to come back up. But last week it peaked one day above the 80-cent level, big psychological hurdle, and a 23% retracement of this sell-off, and then bang, it's just been slammed down again. So the question is, did traders get spooked by something, or is the RBNZ back in the marketplace? It could be a combination of both. With the data that seems to have had the biggest impact was there was some weakness in New Zealand consumer prices. With consumer price inflation easing, that takes the pressure off the RBNZ to raise rates further. They've already raised interest rates by 1% this year. They did 4 quarter-point increases. They've gone on hold. Soft inflation means that they could stay on hold longer. And also weakness in the Kiwi dollar could also take some of the pressure off of them as well as it helps to support their economy. So we do seem to have some support here around 78 and at 77, and it looks as though we may see it move into a 77 to 80 trading range. We've had the RSI had shown it had become extremely oversold, but it got back up to 50 but did not break through, which meant that the broader downtrend still remained intact. It wasn't ready to turn higher. We had the failed breakout, and now we've got some choppiness here, but particularly around the RBNZ decision, nobody's expecting them to do anything on interest rates, but people will be looking really closely at the statement to see, are they continuing to complain about the Kiwi dollar being overvalued even though it's come down substantially, or are they still continuing to threaten to intervene in Forex markets? The other Asia Pacific market that we could see quite active this week is the Japan, and I'll bring up the US dollar yen here as an example. There's a number of things going on in Japan. This week has a number of economic reports coming out from Japan over the course of the week, from inflation to unemployment to retail sales to construction and housing. So throughout the week, we'll see data coming out from Japan that can move the markets and spark action in the yen. On top of that, we also do have a Bank of Japan meeting. There's been recent rumblings that inflation may remain below its 2% target. So the question now is, what is the Bank of Japan going to do about it? Are they going to just stay the course on their QE program of their own, or are they going to try and bring in even more stimulus or pressure the federal government to do something on the fiscal side? Because of this, people will be looking very closely at the Japanese data for signs of, is it weak, or are things picking up, particularly on the inflation side. So the yen has been very active lately. US dollar yen had rallied dramatically with the US dollar rally. It did take part in the US dollar correction, coming back from about 110 down to about 105.50. That was a pretty sizable possible pullback. Now we've seen it moving back up, and it's actually broken out above this 107.80. It's hitting a little bit of resistance here around 108.40. If it takes that out, you could see it come back up into this 109, 110 range. If we do see it falter at a lower high, though, would indicate a strengthening yen. We could see this come back down for support around 107, then in and around 106.25, and then down around 105.50. RSI did peak back above 50, but it does look as though it's starting to go into a more neutral momentum phase where we could see it trading up and down and around 50. There's one other thing I wanted to mention briefly. It is another big week for earnings, and also we want in taking a look at the technology sector is quite significant because we do see a number of stocks trading around key levels. So we'll just start here with Apple briefly. It's actually not reporting earnings. It reported earnings last week. But what was significant about Apple is it broke out over $104. This was a 96 to 104 trading channel with the $100 round number in the middle. Now we've seen upward momentum pick up. It is starting to level off a little bit here. 104 so far has emerged as new support. The measured move out of this channel here measures up towards 112, but that could be over a longer period of time. In the short period of time, it does seem to be consolidating here in this 104 to 105, maybe even up to 106 range, and we'll see, does this continue to hold? The next one wanted to mention, starting with on Monday night, is we get earnings coming out from Twitter, and Twitter has been quite interesting here. It's had a big decline. It's had quite a rebound, but now we're seeing it trading in around here, around the $50 psychological level. Downside support tests on the miss. The first one's around 48.40, and this low here is in and around 46.40. On the upside, if we did get a bounce here, is about 52.15. You need to clear this to signal the start of a new uptrend, because what you've got now is you've had a higher high, now you've got a lower high. So you had a series of higher highs, you've had a lower high, and you've had a lower low here, and you've really essentially, in a sense, broken a bit of an uptrend here, which I'll draw in while I'm talking here. Actually, you've retested a longer term uptrend, but you've broken a shorter term uptrend, and on top of that, not only have you broken it here, but this trend line looks like it's becoming new resistance. So you're at a real inflection point for Twitter. You get good earnings, off it goes back to the races again. But if you miss, it could be vulnerable here. And we've seen other technology-related stocks take some pretty big hits if you've on missing earnings. The other big one is Tuesday night. We have Facebook reporting. And that's also another significant earnings report for the tech sector, not just for broader attitudes towards technology, but also for the stock itself. Facebook's had a great run over the last year or so. It's been leveling off in the last 2 months. It's come up and retested $80 here again. And the question is now, are we going to get a breakout like we did with Apple, or are we going to get a double top with some sort of failure here at the $80 level? If we do see it start to roll over, the first support's in and around here, around 78. This is the 10-day moving average here around 76, and the 23% retracement of this rally here is back in close to 74. The RSI had broken out, signaling an upturn in momentum, but we are seeing it start to falter a bit here in and around 60. If you see the RSI faltering at 60 rather than 70, it's indicative that of distribution, or that there is upward momentum is weakening. So we're looking here at a very busy week this week for earnings, and the one thing I can say is next week gets even busier again. Next week's the first week of the month. You get the purchasing managers, you get the ECB and the Bank of England meetings, you get an RBA meeting, you get the U.S. employment. So we're really into a 2-week period that has the potential to be very, very active for trading, and potentially could create a lot of opportunities. So that concludes my comments for this week, and I look forward to talking to you again soon.